Welcome back. We are back. It's my privilege today to introduce Henry Hansmann, who is a professor of law at Yale Law School. His scholarship has focused principally on the law and economics of organizational ownership and design. And Henry has written extensively about nonprofits, about the relationship between contract law and organizational law, about the historical evolution of organizational forms, and about the structure of property rights. In addition to a number of very well-known scholarly articles, he is the author of a book called The Ownership of the Enterprise, which I highly recommend to everyone. At least it has changed my own view very deeply. Henry is a past recipient of a Guggenheim Foundation Fellowship and a past president of the American Law and Economic Association. So thank you, Henry. And you have the
Well, thank you all. It's a pleasure to be here, a great opportunity. I look forward to the discussion here. Let me say I was encouraged to keep my remarks not too long so we can have a good discussion afterwards, so I'll try to edit a little bit as I talk. I enjoyed the morning's discussion. I learned something. It has liberalized my, maybe it's gone the other way. It's informed me about, changed my views, I think, a little bit about free speech for corporations. I used to think that maybe it's a bad idea, but I've been to Starbucks, and it is manufacturing, actually. So maybe there's something to be said for corporate lobbying. So there are roughly three issues we've been kicking around here, I guess. The first is, should corporate managers have a duty to maximize shareholder value? The second is, do corporate managers overreact to short-term fluctuations in stock market prices? And the third is, should shareholders be given stronger or weaker control over corporate managers? And that control might come through voting control, or it might come through executive compensation, the two tools that are most commonly debated about today. These three questions often get run together, but I think they, to a substantial degree, involve relatively separate issues. So I'm going to look at each of these three issues in turn and start with the first one. Should corporate managers have a duty to maximize shareholder value? A duty imposed by law or a duty imposed by business ethics, either one. Lynn Stout, in the preface to her important book, my good friend Lynn Stout, says, business and policy elites in the United States, and much of the rest of the world as well, have accepted as a truth that should not be questioned, that corporations exist to maximize shareholder value. This is the enemy view, I think. She only cites one source for that. That's me. I wrote a book about 15 years ago, an article about 15 years ago with my good friend and colleague at Harvard, Renier Krochman, titled The End of History for Corporate Law. And as that hyperbolic title suggests, it was designed to be and has become a favorite pincushion for people interested in something other than shareholder value. What we actually say, the language of the book is, of our article, is much more modest and restrained than the title, which we chose to get people to read it, of course. But as we say there, and as I believe, all thoughtful people believe, the corporate enterprise should be organized and operated to serve the interests of society as a whole, and that the interests of shareholders deserve no greater weight in this social calculus than do the interests of any other members of society. The point is simply that now, as a consequence of both logic and experience, there is convergence on a consensus that the best means to this end is to make corporate managers strongly accountable to shareholder interests and, at least in direct terms, only to those interests. And rather than thinking this is a verity that should not be questioned, of course, our article tried to explore the reasons for it, and I'll try to explain some of the reasons for it today. The argument to this effect is straightforward and familiar, I guess. First, as residual claimants, shareholders are uniquely vulnerable to managerial malfeasance. They're the last ones to get paid, and they have no direct contractual claims on the firm. Second, organizations in general operate more tightly when they have a clear and especially a measurable goal, instead of a diffuse set of aims. And third, fiduciary duties, especially when they're imposed by law, lose effect when they require an agent to serve multiple principals who have conflicting interests. in the interest of time, let's take the first one for granted here. We're all familiar with the argument. Second, an organization with a clear goal functions more clearly, much more tightly. I think it's good to have a focused goal. Decisions making can be clear, can be concise, can be easily shared. Everybody can get motivated towards something. As long as that goal is moderately well correlated with social welfare, then it's going to work. Better than having people out to maximize social welfare and not being quite sure how it's to be done, and the organization constantly guessing and second guessing itself as to how to do it. Think of this: there's only one governmental agency in the federal government here that is routinely accused of excessive zealousy, being excessively zealous in the pursuit of its bureaucratic mandate, and that's the Internal Revenue Service. They've got a numerical goal: get those taxes, those unpaid taxes, collect those unpaid taxes. These are really motivated agents out there. As you know, if you've been audited, they're really motivated. So they've got a goal. They've got a goal. But I'm more interested in the third of these issues. Or if I'm not more interested in them, I'm certainly much more prepared to speak about them. At least I might know something about them. So fiduciary duties imposed on managers, I'll argue, become largely ineffective if they require managers to promote simultaneously the interests of two or more constituencies that are not perfectly aligned. And this is particularly true if the duties are imposed by law. That is, law is a very blunt instrument, and it becomes hopelessly blunt if the duties it's called upon to enforce are as diffuse as serve multiple constituencies well. Let me begin by observing that there are many forms of ownership in this society other than ownership by investors of capital. Indeed, as Nicola has suggested, I've made something of a career out of researching and writing about these non-capitalist forms of ownership, and I like them. Indeed, I'm a great fan of other constituencies, workers and suppliers and customers and so forth. They all deserve ownership in their place. It's just not together. In fact, it's odd that Lynn picks me as the target of this. She picks such an easy, a gentle target. You know? She could have gone after Mike Jensen back in the days before he discovered integrity. You know? He was a hard-edged Chicago type. He was really in it for the maximization, for financial incentives. You know, here. So here am I. You know, the banner holder for shareholder value maximization. I'm the guy that gave the keynote lecture at the 100th anniversary of the Finnish cooperative movement. So, well, anyway, but nevertheless, I'm at least, I'm for shareholder value. So there are a lot of conspicuous examples of non-investor-owned business. About half the nation's grain crops are brought to market by agricultural marketing cooperatives owned by the hundreds of thousands of farmers who produce the stuff. About 10% of the nation's electricity is generated and distributed by electricity distribution and generation co-ops. And there are innumerable examples of employee-owned enterprise, including, just for example, every law firm in the United States. But though these various forms of enterprise are owned by different constituencies, if you will, some by customers, some by employees, some by suppliers of other inputs, some by investors of capital, they all have one characteristic in common, which is they have only one of those classes, only one of those constituencies that serves as owner. All the rest are dealt with through contracting. In fact, even if we confine ourselves, for example, to employee-owned firms, it's rare to see ownership shared by two or more different groups of employees. Look at law firms. The senior lawyers in the firm are owners of the firm, but the secretaries usually aren't included. Even investor-owned firms rarely give control to more than one class of investors. Typical business corporation has a single class of common stock, which has voting control over the firm. There may be high vote and low vote stock, dual class stock, but only one of those classes, the high vote stock, has any control at all. The rest might as well have 0 votes. It sometimes does. Sometimes preferred stock gets votes, but never together with, or virtually never together with the common stock. They get a separate block board of their own to block certain kinds of transactions. To arrange for 2 or more potentially conflicting groups to share voting control of a firm, I think, is looking for trouble. And it's easy to see why. Majority voting is a poor way to settle conflicts among disparate groups. This was discovered by George W. Bush, to his apparent surprise, when he tried to impose democracy on a country consisting of 60% Sunnis, 30% Shiites, and 10% Kurds. They get to vote how to distribute the oil. Well, the nearly universal experience, I think, of business enterprise seems to be that voting control must be confined to one group of constituents while other constituencies are protected by market contracting and by regulation. Now, of course, I'm speaking here of sharing of voting control, and advocates of shareholder value maximization may be taking a different view, which is that the corporation should be left, nominally at least, in the ownership of the shareholders only, the investable capital, and but management should be constrained by some form of duty to other constituencies to treat them well. So, can a fiduciary duty, our question is, I guess, if we can't share voting control, can we at least conduct a fiduciary duty on a shareholder, nominally shareholder-owned firm, on the managers of that firm, to look out for other constituencies? And I put it to you, the record here doesn't look a lot better than the record on sharing voting control. To take just one example, look at tracking stock. This was first used in 1984 by General Motors. It went as follows. General Motors had long had one class of common stock that had voting control of the firm. And they acquired two companies, Electronic Data Services and Hughes Aerospace, and they were integrated into the main corporate shell. They were all part of the same, part of General Motors Corporation. They, General Motors created two classes of stock that tracked their earnings. Class E stock, or EDS for Electronic Data Services. Class E stock was given, it had its earnings tied to the accounting profits of the EDS subsidiary. It isn't a subsidiary, the EDS division of General Motors. So they would do accounting, and both their current distributions and the liquidation distributions would be proportional to the value of the earnings and value, asset value of EDS. And the same thing with Hughes Aerospace. It was Class H common stock, and the dividends and final distributions on that were tied to the profitability of the Hughes Aerospace division of General Motors. Both of these classes of stock, the E class and the H class, voted together with the basic original common stock to elect the directors. What happened? Well, the common stock, the old common stockholders had by far the preponderance of votes. So even if they voted together, the E and the H stock couldn't elect directors. So all the directors were elected by the old common stock. What happened? After about 15 years, the directors of GM decided it was time to eliminate the tracking stock, and they did it on extremely unfavorable terms to the tracking stock. They found ways to do end runs around a whole bunch of protective, basically fiduciary provisions in the tracking stock terms that through which they managed to basically suck out much of the asset value of the Class E and Class H stock. The holders of the E and H stock went to Delaware courts and complained that there was a breach of fiduciary duty here, that there had to be fair treatment of the E and H stock, and it clearly wasn't fair treatment here. It met the point of to the details of the law, but it wasn't equitable. And the Delaware courts threw them out and said, look, we aren't going to construct an elaborate body of fiduciary law to protect people who buy this kind of crazy stock, which is rife with conflicts of interest. You buy this stock, you look out for yourself. And that was basically the end of tracking stuff. Other companies issued it, AT&T did, so forth. Investment bankers sold it to them, of course. They got ridiculous stuff. But following some points made this morning. But the courts simply didn't think they could construct a fiduciary duty that would protect two classes of common shareholders who vote together, but have a different fiduciary duty oriented, one not voting at all. E and H didn't really vote at all. But in a similar development, we find that the Delaware courts had played, for the last 10 or 15 years, played with the idea of creating a special fiduciary duty toward creditors of the company when the company is in the vicinity of insolvency. They abandoned that quickly. No matter how badly you treat the bondholders, if it's within your legal rights, that's what they get. And the bondholders have to look out for themselves. There are any covenants in the bonds, which they now do. So, now if the highly experienced Delaware courts, really the best courts of equity we have in the organization of the world, in the United States, probably any place, find that it's unworkable to create a legal fiduciary duty toward more than one class of shareholders, stakeholders at the same time, then I don't think we have much hope that any court is going to be able to do it. Labor law offers another example. If we want to move outside of corporate law, there is a duty of fair representation in labor law. This is when we had labor law. Remember labor law? Well, when we had labor law, there was a duty of fair representation in which a union had to look out for represent fairly the interests of all the workers in the union, even if they were disparate. And so there was a common problem in unions, of course, and that was probably the reason obviously the reason for the duty of fair representation was that typically within a union there's a variety of skills of workers and pay rates. And there are more unskilled than skilled workers in a typical union. And so the tendency is, controlled by votes, to give high wages, to bargain for high wages for the unskilled workers and basically screw the skilled workers by bargaining for low wages for them, the lowest they would take. And that kind of bargaining was never touched by the duty of fair representation. The only things for which the duty of fair representation has ever been invoked, not successfully invoked, is for racial discrimination and gender discrimination. If you bargain for wages for minority people or for women that are 50% less than for white people doing the same job, you breach the duty of fair representation. That's all they can do with the duty. Anything more subtle? Not possible. Not possible. In front of the Labor Relations Board, which was an expert rulemaker and adjudicator. Even if we look at a single class of stock, there can be differences among there can be difficulties in enforcing fiduciary duties of management. That is, we shouldn't get too carried away with the ability of the courts to enforce fiduciary duties imposed even upon managers who are managing a shareholder-dominated firm whose duties fall only to shareholders. So, as we know from this morning's conversation, about the only instantiation that's effective of the so-called duty to maximize shareholder welfare in Delaware is the red line rule. That is, if you can't, if you're selling the firm as a whole and you have two offers, one of which is conspicuously higher than the other in terms of cash value, you can't sell to the person who pays you less. That's not a trivial rule. I agree with those who think, Bart and others who think that's not a trivial constraint. But that's pretty crude. That's all you can do with a duty, a fiduciary duty, is to say you can't sell it to a low-value purchaser. Well, but so much for familiar institutions. To get some further perspective on the shareholder value norm, let me introduce you to a rather more exotic type of organization. Here's a little quote from the Economist magazine. The issue of February 2 last month was a special section on the Nordic countries, and titled "The Nordic Countries: The Next Supermodel." And it's very favorable, a very favorable treatment of the evolving economies of the four Nordic countries. Here's the beginning of one of the articles. The Nordic countries have an impressive number of globally competitive companies. Denmark is a world leader in hearing aids, Oticon, shipping, Maersk, toys, Lego, drink, Carlsberg, and wind power, 200 firms. Another firm they mentioned, Novo Nordisk, which is a pharmaceutical company. Novo Nordisk is at the center of a biotech cluster of Medicon Valley that stretches from Copenhagen to Malmo in neighboring Sweden and has an annual turnover of $13.4 billion. Well, there's one thing the Economist doesn't tell you about these companies that's interesting. Of the 5 companies mentioned in this paragraph, 4 of them are controlled by nonprofit foundations. 4 are controlled by nonprofit foundations, so-called industrial foundations. What is an industrial foundation? So typically the story is this. An entrepreneur builds a company, a company he owns and controls, maybe 100%, maybe just a controlling block of stock. When he comes about to retire or die, he finds that there is no son or daughter that he's prepared to pass the company on to. So he creates a foundation. It's old Mr. Svensson's for the Svensson porcelain factory, and he creates the Svensson Foundation before his death, and passes his controlling interest in the Svensson porcelain factory the Svensson Foundation, which has a charter that calls upon the directors of the foundation to manage the company perpetually, to keep it alive and healthy and operating up to the great standards that it operated with under Mr. Svensson. And it has a secondary objective, which is if there are funds, surplus funds, if there are funds that aren't needed for reinvestment, they can and should be devoted to charity. But it's clear that maintenance of the company is the first thing. And this is somebody buying immortality. Mr. Svensson couldn't imagine the world without his Svensson porcelain factory. So now the board of this foundation, the foundation only owns one thing. It owns a controlling interest in the Svensson factory, and it has a self-appointing board. No elections. It has 7 people, self-appointing board, as the slide says, they reinvest, but they occasionally, when they've got extra money, they pass them out as charitable contributions. And it's not insubstantial. About 2% of assets is paid out in charitable contributions on average for these foundations. The company itself remains an ordinary for-profit business, share-based business corporation. It has its own board, its own managers. There's no ongoing tax benefits. Once you set the thing up, there was a little tax benefit to set these things up, which is now gone. But once you set it up, there are no ongoing tax benefits, no tax subsidy. So, well, now as that quotation from the Economist suggests, this turns out to be a pretty effective ownership structure. If 4 of the 5 leading firms the Economist tends to want to point you to as models, this is modeled, the implication is models for America and Britain, they must be doing well. In fact, they are doing well. Companies controlled by industrial foundations represent about 1/4 of all industrial output in Denmark. It's a lot. Maersk Shipping is the largest container shipping company in the world. Carlsberg Brewery is the 4th largest brewery company in the world. You don't see it much here, but go to China, it's all over. And so on. These are serious companies, and large companies, many of them. Here in red, I've got a comparison here for various periods of time, 3 different comparisons, comparing return on equity between foundation-owned firms, which are on the right-hand column, family-owned firms in the center column, and firms with dispersed investor ownership in the first column. In the first study, return on equity 1982 to 1992, we see that foundation-owned firms get 11.4% return on equity, just slightly better than the other 2 kinds of ownership firms. And the same is true for 1995 to 2002, and the return on equity for 2003 to 2008 is just insignificantly, about 1% insignificantly lower than that for the other more conventionally owned firms. So these firms do very well. On average, as far as we can tell, they do as well as, even slightly better, as well as conventionally owned firms. So here are firms that have nobody pressing these firms into shareholder value. These managers are autonomous. We have 2 boards, the board of the company and then the board of the foundation, which elects the board of the company. And the board of the foundation, as I said, is you can't have proxy fights to get rid of them. You can't have corporate hostile takeovers. These guys are completely immune. They're entrenched. Carlsberg Beer has been an industrial foundation owned by an industrial foundation since 1887, 125 years. It's still very profitable. And we're talking profits here. Profits. They're more profitable, or as profitable as conventional industrial firms. So the first thing we find is maybe you don't need a lot of shareholder activists to make a company profitable, I guess. Maybe second thing you learn, the value of having a goal. Why are these firms so profitable? These foundation firms so profitable? They seem to take profit maximization as a goal. That is, or they take that as their measure of performance. They set out to maximize profitability, I guess. Partly because that's tied to long-term sustainability, that is, in a different sense from the one we did here today. Long-term viability, maybe because it's an attractive norm, maybe because that's what the Danish business community expects them to do. But in any case, they do it. And so we see here a non-profit foundation giving its money to charity, run by an unconstrained, self-perpetuating board, deciding that they're going to pursue, or shall I say, shareholder value maximization as the norm. And are they getting carried away with it? No, or are they any better than, in terms of shareholder value maximization, than other Danish firms? No, it looks like they treat their employees about the same, similar wages, similar terms of work, similar labor productivity for both kinds of firms. And indeed, I think one would say from looking casually at these firms that there's not much difference in the treatment of other constituencies between the foundation-owned firms and the Danish, ordinary Danish enterprise. So there may be something, let us say, rather natural about the norm of shareholder value maximization. Why would that be? Well, I think this maybe is not so surprising. The reasons have been reviewed already. It's not in the shareholders' best interest in terms of long-term profitability to abuse employees, to cheat, to steal, and so forth. You treat your employees well, you treat your customers well, you treat your investors well, your creditors well, and you do well. You get a bad reputation if you start cheating and stealing from people. And then, secondly, I think shareholders in shareholder-owned corporations, they may want the company to maximize shareholder value, but shareholder value, of course, goes beyond money. I think most shareholders don't want the company just to cheat and steal whenever it's possible, to abuse other constituencies just to get a buck for the shareholders. I don't think that's typically the motive of shareholders. I put aside the people who own investment banking companies. I'm not sure about their motives. They're closely held by people who maybe, but anyway. But other than the shareholders, the controlling shareholders in investment banks, I think the typical shareholder wants the company, his or her company, to operate with reasonable values. And if you're maximizing shareholder value, you aren't cheating and stealing people. There may be a reason you're doing that anyway, but it isn't because you're maximizing shareholder value. Shareholder value recognizes the ordinary norms of the business world, I think, which are fixed. So maybe that's why there's parity between the foundation-owned firms and the investor-owned firms in Denmark with respect to treating employees, customers, etc. They all get treated pretty well. Of course, this is Denmark we're talking about. Denmark may be strange, but we can talk about that later. We'll come back to industrial foundations again shortly, but I want to look at our second main topic. Do corporate managers overreact to short-term fluctuations in share prices? There's a lot of anecdotal evidence that they do, and now we have some good statistical evidence that they do. There's a wonderful study by Asker, Ferramensis, and Lundqvist comparing privately held and publicly held firms in terms of their investment behavior. And what they find is that privately held firms, first of all, invest much more on average than publicly held firms do. Secondly, they are much more, how should we say, much more thoughtful in when they invest. Publicly owned firms just tend to pick a straight level of investment and continue on with it. The privately owned firms are much more sensitive to opportunities, it appears. And third, they argue their results are highly consistent with the notion that in publicly owned firms, managers are myopic, they're behaving myopically. And the ones, and in those industries where share fluctuations are large, they're especially sensitive in adjusting investments to share fluctuations. So there's some evidence, moderate anecdotal evidence, and pretty impressive statistical evidence that there is a short-term value problem here. But of course, the solution to this isn't to abandon shareholder value maximization as a norm. Rather, it's to somehow get managers to manage for the firm for the long run rather than for the short run. Managers are perfectly capable, of course, of managing a worker-owned firm for the short run versus the long run, or treating workers in the short term. That is, it's easy to hire workers, promise them a lavish pension, not funded, and there you go. At the end, the workers are in trouble, and so is the company. One can be short-term with any of the constituencies. You can design products that are going to make a lot of money now, that are going to blow up in a decade or something, and leave you with nothing. So I think the question of short-term, long-term isn't a question of shareholder value versus other constituencies. It's a question of finding some way to get managers to focus on the long term, even for shareholders. Now, one way to do this might be to further attenuate the degree of control that shareholders have over corporate management. Which brings us to the third topic. Should shareholders be given stronger or weaker control over corporate managers? Well, of course, there's enormous controversy today concerning the degree of authority that should be given to public shareholders. The answer to that problem isn't necessarily dictated by acceptance or rejection, however, of the long-term shareholder value as the principal objective of the corporation. Let's consider voting first. First voting, then incentive pay. So it's perfectly possible, of course, and maybe what the critics of shareholder value maximization have in mind, that one reason why managers are myopic for public companies is precisely because there's a very high salience to stock prices in the short term. And so this argument about focus goes too far. They're too focused on something that's highly salient to them. And maybe to reduce that salience to them, we should, maybe to salient takeover experts and so forth as well, maybe we should reduce the amount of control that shareholders have over management. And our now familiar industrial foundations are some example of that. Some of these foundations have a minority of their shares traded on the Danish stock exchange. Most of them, the smaller ones, don't. But whether they do or whether they don't, the managers, as we said, are entirely free from any kind of exercise of control of shareholders shareholders. And despite this, their record is very good in making investments in long-term shareholder value. Their long-term profitability is quite favorable. And the holders of minority shares of these companies are treated very well. They've done very well in comparison to holders of shares of conventionally owned firms. So this provides a little support for the view that while the pursuit of shareholder value may be the appropriate objective of a business corporation, strong shareholder control over the corporation may not be the best way to get there. It might not even be a good idea at all. Now, of course, comparisons between the US and Denmark are complicated. Nevertheless, these industrial foundations do give us some reason to believe that for pure fiduciaries who are not controlled by their principal, perform a little better than you might expect them to perform, just through casual reflection. And certainly perform a lot better than is assumed by the extensive, pervasive literature on managerial agency costs, which is flooding business schools, finance, economics departments, and law schools. Maybe we should reassess just how serious the managerial agency problem is. Maybe it's not all that big a deal. But what about incentive compensation? Is that a better way to align the interests of managers with the long-term interests of shareholders? And maybe it is. And of course, there's much controversy about this. But now, the argument for it is, of course, that if managers stock options, for example, they will be attuned to the price of stocks. If they can hold those stock options long enough, they'll get tied to the long-term value of stock. But there may be something else going on here, which is troubling, which is the communicative or expressive aspects of incentive compensation. When you give a director, or in more particular, a CEO or senior manager of a company, a package full of incentive pay tied to various indices of corporate performance, what signal are you sending to that person? And I think maybe I'm worried. I don't know. I don't have any evidence, but I worry that you're sending to that CEO the message that the company thinks you are motivated entirely by your personal financial income. That's what you're in the game for. What's more, we think that ought to be your goal. And we're going to give you compensation based entirely upon that goal. And so you want your management firm to maximize your personal income. And we've got the incentive set up for you to do it. And the manager thinks, all right, that's very self-conscious, but thinks, all right, that's my goal. Now, how am I going to satisfy my goal? I got to choose between spending a lot of time working at the office, or I can spend some time backdating my stock options. And they may think, as many executives seem to think, that backdating the stock options was okay. There's a reason why 2/3 of American firms did it. They thought it was okay. it's just incentive compensation, kind of backdated. So incentive pay may not be a good idea for two reasons. One is there's no way to design it so that even if the person's maximizing the personal income, maximizing the personal income is going to make the corporation run terrific. You just can't design incentives that closely. And secondly, you may be having this counterproductive effect of sending the wrong signal to the manager about what they're supposed to do. So maybe we're stuck with normative. I've convinced you, I hope, that legal fiduciary duties aren't going to go very far either. And maybe we're stuck really with managerial norms coming from the business community here as to investing for long-term value. The Danish industrial foundations, I guess, show how powerful business norms can be because they get no incentive pay. They get the directors of the foundations get a fixed pay. It sounds like just driven by norms of the business community. Firms of all kinds, in every industry, consulting engineering, pharmaceuticals, transportation, breweries, eyeglasses, earphones, hearing aids, everything seems to work just fine when it's managed by, well, I was about to say when it's managed by firms whose managers have no financial stake in the outcome of the firm. That's not quite right. The lesson of the industrial foundations is surely that norms will do much more than we think they might do, but it isn't quite that just taking away incentive pay from corporate managers is going to make things work well. The Danish industrial foundations, remember, have an ordinary corporate board and CEO, officers, and then there's a holding company up there. The self-perpetuating board is on a holding company that just happens to own the stock of this for-profit industrial company. And that seems to be important. Work that I and a colleague of mine have done suggests that the industrial foundations that work the best are those where there's some substantial distance between the foundation and the industrial firm it owns. And by distance, I mean, for example, most importantly, there'd be substantial separation from the boards. Some of these industrial foundations have the same board members on both the foundation board and the company board. Some have no overlap, and there's everything in between out there. And if you compare them, it looks like the ones that have very little, not no overlap, but only maybe one person overlapping, two at the most, between the management board of the company, the board of the company, and the board of the foundation. Those companies seem to be most profitable. And the best I can think of what's going on there is that we have an owner here. The corporation has an owner. It has a controlling owner. It's a foundation. The foundation has directors. The directors must think of themselves as a separate entity from the business company. The foundation is a separate entity. They are a separate board. They don't run the corporation. The company, the operating company, but they run the foundation. And they seem to think of themselves as owners, virtual owners of the company. They seem to have enough psychological distance to identify with the foundation and think of the company as something they own, and therefore whose economic performance they want to be substantial. They are rapacious about it, but they're perfectly clear that they want that company to perform well. Or so I interpret from the data. So it seems to be important that there be a supervening set of, a shareholder up there that is separate from the company, that puts pressure on the company to do the right thing. I talked once with Christian Dubig, who's the CEO of the Lundbeck Foundation, one of these foundations that owns, in this case, the Lundbeck company. It's a big pharmaceutical company. They make central nervous system drugs. Lexapro is one of their many products. And he made the observation that it's important for a company to have an owner, a good owner. And he ought to know, he was in charge of M&A for Morgan Stanley in Germany and the Nordic countries for 12 years. And he left that to set up a private equity firm of his own. He made a lot of money. And after a decade or so of that, he put that aside and he accepted the position as CEO of the Lundbeck Foundation. And he was offered incentive pay, not much incentive, but he was offered pay on an incentive basis if the company did well, did control enterprise well. He rejected it, didn't want it. Thought it would be distracting, unproductive, take a straight salary, and a low one. Nothing, not meaningful money for him, this company. But he knows something about managing companies. And he thinks the company ought to have an owner and have a good owner. What does he mean by a good owner? Just the kind of things you'd imagine. He wants to have a sounding board, somebody who will give you good advice, who will criticize you on your own advice, have some perspective on what you're doing, be prepared to second guess those things where you're overly invested in a decision you made already, and you kind of, you know, you're too enthusiastic about it, and you can't step back and say it was a bad deal. Prepared to intervene when management can't correct itself, but really only then. But this implies that the company, the owner, is a more or less unitary owner, a controlling owner. And maybe there's something in this. And maybe this helps explain the tendency toward privately held companies today, why so many publicly held companies are going private. It may not be overregulation, but it may be that it's more effective to run companies that way. The experience of the Industrial Foundation in this sense show another thing, I think, which is that with two entities, you can serve two different constituencies, each entity focusing on a constituency. So look at the Danish Industrial Foundations. The operator of the industrial company, the controlled company, is out there to sell hearing aids and make money. And they do. And they don't give any money to charity. They just make hearing aids and sell them and do research on hearing aids. These companies are all very innovative companies. And competitive in the world markets too, I would say, unusually so for those companies. The foundation, on the other hand, does all of the charitable work. And they're very clever about what they invest. The Lundbeck Foundation invests in research related to central nervous system disease and so forth, building up the capacity of Danish universities in those fields, so forth, training people that Lundbeck can use. And they know where to make their charitable donations effective and how. So in a sense, they've divided up tasks. The money is made, profits are made by the foundation-controlled company. The charitable contributions are made by the foundation. Division of task here. Just going to skip it. The Organization of American Hospitals looks like industrial foundations a lot, but I'm going to skip it. I want to say something about social enterprise. Maybe these observations have something to do with some of those firms we call social enterprise. Social enterprise is a term that's used by many people to cover a lot of different kinds of hybrid types of organizations. But one important class looks like are multiple entities. They're entities typically where a nonprofit corporation, like the industrial foundations, controls a for-profit corporation. So one example might be Comportamos, the microfinance firm in Mexico, a huge firm, business corporation that makes the loans and collects them, but a controlling share of the stock is owned by a nonprofit corporation, and presumably the Comportamos, the for-profit microfinance institution, is out there trying to squeeze as much as it can of the peasants it loans to. The brakes are put on by the controlling foundation. Another example is something you find a lot of work incentive enterprise, sheltered workshops, in which, like the Greystone Bakery is a famous example. The bakery, a for-profit firm, it hires handicapped people to try to give them skills and training to get into the basic job market. Its shares are all held by the Greystone Foundation, which channels a small subsidy to the for-profit corporation. It doesn't take dividends out; it just takes a low rate of return out. I think is what happens, and it initially capitalizes the company, and that subsidy is titrated just to be enough to get by, so that there's some incentive on the part of the bakery itself, the for-profit bakery, to be efficient, to get out of its workers what it can get out, but not more than that, not more than they're capable of doing, but what they're capable of doing. They could have set up in one organization, one nonprofit shell, the foundation and the workshop. They split them. I think the incentives are better if they're split a little bit between these two firms. The suggestion is, I guess, the Northwestern University would be better if they split off the solicitation, fundraising, and endowment from the commercial part of the business, which is the education department institutions. Who knows? Well, so the question then comes up finally: can we get to long-run shareholder value by interposing for American publicly held firms by interposing another level of intermediaries. So they all have a holding company. There need to be a nonprofit holding company, maybe a for-profit holding company, of course, as well, and that then in turn is owned more broadly. Maybe the future of American capitalism is to have retail shareholders like you and me invest in mutual funds then invest in private equity firms or hedge funds or some other kind of activist investor who then in turn control operating firms. And maybe that's going to be better. Give every operating firm an owner. But that's fairly speculative. I just throw it in. So, in conclusion, as a practical matter, I think society is probably best served by keeping long-term shareholder value as the principal legitimate goal of corporation managers. The harder question is how to implement that goal. Reformist efforts at the moment are increasingly focusing on shareholder voting power or incentive compensation to line up the interests of managers with their principal constituency. But all these mechanisms have their weaknesses. With a consequence, we put only very limited faith on these conventional remedies. And maybe a more promising approach to good corporate governance in publicly held firms lies not in adjusting the means of control available to shareholders, but rather in changing the shareholders. Don't change the company, change the shareholders. People ought to be restructuring the companies, the entities that are shareholders in large business enterprise. And not clear, but it's worth thinking about. Meanwhile, of course, there's everything to be said for sensitizing business managers to the values of the society in which they operate. They may get a little too focused on money, and I take it it's important upon us to, and especially among people in business schools, law schools too, I guess, to remind business people and encourage them to think that they should they should live with ordinary business morality as the first thing on their minds, on their agenda, and that they should mind their P's and Q's and look out for long run, not short run value, but in particular treat other constituencies well. Smart managers know that, I think. The dumb managers need your instruction. I encourage you to give it to them. So that's my end of my remarks. Questions?
It seems like this separation is important that you're describing in roles. And there are at least two reasons I would think that this might work. One is transparency, and the other is culture. Is that something that you have thought about or you can talk about?
I think one feeds the other. A culture that operates with no information isn't a culture that's going to bear on anybody very hard. So, when those 6 choices were put up there, my thought was all of the above. All of the above. I think you can't get by without some regulation. Now that unions have collapsed, we respond to regulation, OSHA, ERISA, sexual harassment, representation, sexual discrimination, so forth. And you need some regulation. Labor markets are weak, and on the other hand, I think in the end, it's all norms. You only get the legislation when the norms are there to pass the legislation, I think. So, to begin with, there's got to be norms.
We talk about shareholders. What about employee stock ownership?
So I've written a lot about it. I'm not so keen about it. The American experience is a legal problem. The law is structured for employee stock ownership to give employees incentive pay, but no control. That is, the ESOP regulations don't require any pass-through votes. Indeed, they make it artificially easy for you to give the workers a very large fraction of the earnings risk in the company, if you will, without having zero voice. And there's an American industrial foundation I'm familiar with, a small one that was constructed with ESOP. ESOP, and nominally the workers own the company, but they'll never get control. And management, the self-perpetuating management, controls them. That's 7 subsidiaries. I think industrial foundations may be a good thing for America. We outlawed industrial foundations in the tax law for various reasons 40 years ago. Probably a bad idea. But anyway, I think, as I say, if workers control the whole firm, it might be a good thing. In 1994, United Airlines was sold to its employees, then the biggest airline in the world. And originally the pilots were going to buy it, 6,000 pilots. They were going to buy it themselves. They got some financiers finance company was willing to put up the money for them, and they aren't for themselves. And they're a fairly large element of the payroll. And I think it would have, as it would have flown if they'd done it. However, heat was put on them to the mechanics union, machinists union, which is also very big united, protested. And the deal was finally, because they hated the pilots and vice versa. And the deal finally was done. Combined both of them in the buy-in. Both the ownership was shared between the machinists and the pilots. They did spectacularly well. The first 2 years, it was great for the airline industry. They made tons of profits, more than they ever projected. The result was they fought over the division of the profits. It was more than they expected. They hadn't planned for it. The pilots tried to go on strike. If they didn't get more of the profits, then there was cut provided for an initial bargain against it, a no strike pledge in the agreement. But if you can't share the good days, if you can't share just manna from heaven, what's going to happen when things get difficult? Well, it's not employee owned anymore. But I think that it's just been the pilots that might be worse.
Why do you think industrial foundations rose up in Nordic countries, and will the recent publicity on the Nordic successes cause that idea to spread beyond Nordic countries in general?
It's not just Denmark. They're all over Northern Europe, Germany, Sweden, Switzerland. IKEA is a foundation-owned company. In India, Tata, what's that? Tata Industries. Industrial foundations. The family has been setting up these foundations. The last Tata has just given up its directorship.
Why were they set up originally? What was the
I think it's immortality. I think the Tata Industries will live on for centuries, probably. And as Tata Industries, nobody can take it over. And I think it's that. It's immortality. I don't think they're doing it for social efficiency. All right? They think it's efficient to have the Spence Enforcement Factory operate forever. The taste might change, doesn't hurt. But the firms have no flexibility. They've hung in there for years. They have to be flexible. But I think that the instinct is universal. America used to have a lot of industrial foundations. There's only one left, the Hershey Company. The Hershey Chocolate Company is controlled by the Hershey Foundation for various loopholes. And it's done extremely well. If you bought stock in the Hershey Company 20 years ago, you would have outperformed this, and just put your whole portfolio in Hershey, you would have outperformed the S&P 500 by 400%. Now it's politically corrupt and there's some other problems, but
Yeah. Thank you. So, Professor Hansmann, I've learned so much about corporate law from your work, so this question definitely comes from an admirer. And one of the things I learned is your work on entity shielding and the asset disentanglement that accrues. So, meaning, for those who haven't read the work, that the assets of the corporation are completely disentangled from any property of the investors, such that the assets of the corporation are what bond the contract of the corporation. In a sense, what that is saying, right, is that the corporate entity owns the property. It's corporate property, and it's totally separate from shareholder property. I mean, I'll let you dispute that in the answer if you want to interpret it differently, but I draw an implication from this. So it seems that the Danish firms, you show this particularly clearly, right, where you have an industrial foundation, clearly those board members don't own the corporation, and they have a company board, clearly they don't own it. Who owns assets of the corporation? It's the corporation that owns those assets. So given that, I guess I'm a little puzzled by your use of the term ownership, and if I understood your claim correctly, why it's important that someone be assigned ownership. It seems to me, no matter what the organization of the board, it's always going to be the case that this abstract legal entity, the corporation, owns the corporate assets, and the only issue is control, right? And in terms of the control, it seemed you had evidence that showed that your shareholder pressure leads to myopic performance, if I understood that correctly. And so it would suggest that shareholder control isn't necessarily where we want to go. But then you talk about the shareholder interest as still being a kind of viable goal for the firms to be oriented toward. But again, it seems to me that the Danish firms really show something different. That in terms of what motivates managers, right, from a sociological point of view, this is not so mysterious. It can be motivated by income.
but it can also be motivated by power, a desire to be able to control a large firm. It can be motivated by prestige, or motivated just by the inherent interest of the work. And so all of those are motivators, quite independent of any kind of incentive toward income incentive in your performance. So it seems, given all of that, that it seems a completely, I guess another way to interpret this, right, is that what we really want from firms is a kind of orientation toward long-term growth that creates employment and creates goods that people want, right? And that the way to do that is by structuring control such that it isn't, toward the short-term party, say the shareholders, but then it opens up any, large variety of other potential people who might control it, including it could be just these fairly autonomous managers who are motivated by these other, motives other than just kind of maximizing their own income or stock price or something like that. I hope that wasn't too rambling to follow as a kind of question. I'm just curious if that makes sense as a kind of way, another way to interpret this, other than saying that therefore we should have a kind of unified ownership of these enterprises. It seems to me it's really ownership isn't the right term now.
Yeah. So what the industrial foundations are here. Here's the foundation, and it owns 50 to 100% of the stock of the operating company. This is a separate, to use the term we've been using this morning, legal person from this. These are different legal persons. This one is a shareholder. This person owns this company, or owns a majority of this company. Separate company. And that separate, and this is, there's a board of directors up here. It's the board of directors of this foundation. And they decide what the policy of the foundation is going to be. But there's another board down here that decides what the policy of this operating company is going to be. Of course, they can't be too unpleasant to the people up here, or they'll get replaced. But so there's a difference between having an operating company, which is supposed to make the operating company non-profit. We just had a self-perpetuating board here and said make hearing aids. It's a hearing aid factory, but it's a company that's just non-profit, and doesn't have any shareholders. So it's a self-perpetuating board. Second form is what we actually got. You've got the nonprofit entity up here controlling a for-profit entity with its own board. My argument is the latter, the two different entity solution, works better than the one entity solution. That just making the board here self-perpetuating and insulated from any outside pressures and getting rid of this won't do it. So these are separate persons, separate entities, egg shielding, all that, and but this is a shareholder. This is our constructed shareholder here.
And what is the story behind that? What the reason why what you just said is true?
Why? Where did this?
Why is it true that having the separate boards somehow gets a better result than having the two boards be the same?
Yeah, the best I can do is to retreat to economic theorists working out with theories of identity. And the question is, what do these guys who are on the board up here think they're doing? What do they think? These are not young hotshots building careers. These are people who are older than the directors of operating companies. These people, the average age 64. This is their last job in life. And sometimes they're former executives of the operating company. Sometimes not. If you ask them what they think they're doing what's in the charter. When old man Svensson died 100 years ago, he wrote a charter and said, run this company, the board of directors is charged with running this company with the efficiency and according to the standards that old man Svensson followed. And they do that. They say that's our chore. And to maintain this company is a viable going concern, keeps high standards, and so forth. And why would they be any better? What if you just put them down here, and made a nonprofit? Here, our argument here is, maybe I have to retreat to behavioral psychology, that there's, even if they're good intention down here, they're myopic. They make an investment. They open a factory in Brazil. It looks like a great investment opportunity. They open a factory in Brazil, and it works out poorly after 3 years. The manager said, we can't have made a mistake. That must have been a good decision to invest. We invest more. We just put more money into it. Sooner or later, it's going to be profitable and pouring cash into the people. in a black hole. These guys up here aren't invested in that decision so much. These guys made it. These guys, their job is to have perspective on that, think about it. And they can say, look, guys, that Brazil, we're going to trash that Brazil plant. No more, basta. It's a loser. It's hard for you guys to see it, but we forbid you to go out with it. And
can I just ask a question?
Yeah.
Just you gave an example there. Would the Industrial Foundation Board get into an operational question like you just said, or would their only question be, who are we going to name to the operating board? And they never get into the question of whether we should continue to invest in this thing.
Well, I think it varies from one firm to another, and I don't attend board meetings of these firms, so I don't know what they precisely do. But from talking to, I've talked to the CEOs of maybe 5 of them, and my sense is they vary a bit, but it's more than just electing the directors. Now some of them are a joke. There are some that the power's down here, and these guys are running it themselves and so forth. But in most of them, the board seems to be a serious board, and they certainly pick the managers, and they fire the manager. There's higher manager turnover in the industrial foundations than there is in comparable industrial firms. And it's correlated to how well a firm does. When a firm does badly, the industrial foundations are faster to fire CEOs than the business corporations. So they're attentive. They're paying attention to the way things are going. And my understanding is they review policy. They meet regularly and monthly or whatever, and review the firm's policy.
So is it not then the implication of what you're saying that we ask directors to do 2 things? We ask them to be stewards of this thing called the corporation, but we also ask them to be sort of oversee and supervise the operation of the firm. And then in fact these are 2 very different functions, and it's very hard. First of all, maybe someone who's good at one might not be particularly good at the other. But in any case, if you're trying to do them both at the same time, it sort of overloads the circuits and it's confusing. And in fact, probably the operational stuff tends to overwhelm the stewardship stuff. And so if you can separate this with 2 different groups who don't have to sort of do the same thing, it more reflects the fact that this is a dual function on the board that shouldn't actually be within the same group.
Yeah, I think that may be true. The best expression of it was given by Jensen and Fama, I think, some years ago, who said, look, running a company involves 2 functions. There's the execution function, and there's the monitoring function. If you just involve execution, you don't have perspective. You've got to have somebody out there to monitor. And that was the argument why you have a board that's separate from the officers. And because the board is providing the monitoring function. All we're saying here is Fama and Jensen didn't go far enough. It's actually works even better if you got a holding company out there that's a separate entity. With a manager, you've got 2 boards on top of the officers, basically.
So is this why, and some people here might recoil at this, but that large, sophisticated private equity firms essentially operate on the same, not legal model, but in the same model in terms of this sort of stewardship versus operational control, is they seem to operate that well, and they have very successfully run their portfolio.
Maybe the same thing. There are reasons to worry about moving from the non-profit to for-profit holding company mode, and it's not clear. Maybe if the directors of the holding company think that they're working hard just for to put money in the hands of some dispersed shareholders who didn't do anything to earn it and have no particular merit, it'll work so hard. They work for a non-profit, which is their nonprofit. The whole nonprofit is them. They run the nonprofit. There's nobody else telling them what to do. That's they do own the nonprofit in a psychological sense. And they're also in charge of giving money to charity or whatever. Maybe they wouldn't do that kind of work just for rentiers, for people collecting dividends and not putting in effort. But the evidence of hedge funds and especially private equity firms suggests what you said.
Could I suggest that the industrial foundation model is very, very similar to the family business model, the family-held business model. And you have in your data, you have the 3 columns. You have the family businesses separated. Is your data suggests that family businesses are more like this, or more like the widely held company model?
We have only the aggregate data for family firms. And it wasn't I who did that study, so I can't tell you much about family firms. But let me pick up on the substance of it. I think, so here's one theory of what's happening. In family firms, have a very mixed record. 3 generations, rags to rags. The first generation, the entrepreneur does a great job, entrepreneur's daughter does a pretty good job, and entrepreneur's grandson just runs the company into the ground. And it may be better if entrepreneur creates the company and then passes it on to some group of professionals, let us say, just business people who don't have an equity in it, but who understand that they're charged with keeping the company up at the level it was when old Mr. Svensson ran it. That's pretty good. And you want to be director of a company, and people run around and the business club in Copenhagen and say, look, Svensson ought to run a company, but Hansmann, who's on the board now, they're running this thing to the ground. You don't want to have that. You've got your reputation and your sense of self-esteem. And your wife's appreciation of you. It all depends upon whether you run it as well as Svensson ran it. Why can't you run as well as Svensson ran it? So he's kind of put in concrete the family firm. He's put himself. He's succeeded in reproducing himself forever.
But later generation families actually create this form. And they see themselves as the long-term stewards. They could even put it into a trust and even make it stronger. But they see themselves as the industrial foundation board, not the operators.
Yeah, they see themselves that way. They don't often act that way.
Not always.
But you see combinations. The Tata Industries is a combination, evolving combination of industrial foundations, and it's sometimes controlled by family members, sometimes not, and ownership of stock by the family and so forth. And the Wallenberg Empire in Sweden, which owns about half the industry in Sweden, is a combination of industrial foundations and family corporations and so forth. So it's used for leveraging. But the reason we focus on the Danish firms is there's reason they're clean. They aren't used for leveraging, for pyramiding purposes, family control. They aren't used for tax evasion or avoidance. IKEA, we believe, is actually owned by Swedish people. It's incorporated in the Netherlands. We believe it's a tax scam and a pyramid scheme. Our data, we don't have this. The Danes are good.
It's just a simple question. There have been a couple analogies here as far as private equity and family held. Is this industrial foundation, is that always a one-to-one relationship? Is that part of that structure, or can they own more? Are there more companies underneath that?
Excellent question. The typical mode is one foundation, one company. But some of them own 2 or 3. I don't know of any that own more than 3. But the Lundbeck Foundation, for example, owns 3 firms. It owns the Lundbeck Company, big pharmaceutical. That's most of what it does. But it's got 2 other firms: an emergency services firm, ambulances, things, and a third one, which is a nutrition firm or something like that. They're slightly diversified. Now, let me say there's some evidence. So conglomerates, big conglomerates, as we know, perform very badly in the long run. Little conglomerates, there's some evidence, statistical evidence. Maybe owning 3, 4, or 5 firms seem to work pretty well. So it may be transferable to the for-profit world. Bernie?
So to push the family firm analogy, Randall Mork has this fun paper on sort of Japanese businessmen adopting adult sons who can run the business when their own kids aren't up to snuff. That's looking closer to your model, right? Which is you have the family owner, but you don't have the problem of the 2nd generation or 3rd generation child just not being able to run a business. Comments?
Yeah, sounds to me it may work as well, even better than industrial foundations. As long as you trust. The difference is that there's a whole board up here. There's 7 people on foundation boards up there. They're picking their successors. If it's just son who picks his successor, you're a little worried about high mean, high variance. But but I would say that what's going on is basically the same. They found a way for the founder to perpetuate competent control while keeping it in the family, while keeping it from the public's hands.
I'm actually was struck from your point that the Danish are good people, which is definitely something I agree upon. This structure is used in Italy to do one of the, the worst corporate structured are used exactly with this. So
I mean, refer to the banking foundation.
Yeah, and one worry I have is that what you find is just really specific to Denmark.
Let me answer. I see the question. Let me answer.
They're very good people.
So Italy has 72. Italy used to have mutual banks. They were socialized at the end of the 19th century. The government banks, and then they unsocialized them. They privatized them 20 years ago. And they split them up so that there's the bank is for profit now. Ordinary shares, and initially all the shares were held by the foundation, and the foundation was under an injunction to sell off the controlling block of the shares, which they did slowly. I don't know if most of them have done it by now, but anyway, these banks didn't quite achieve the efficiencies that you might have wanted. It was especially obvious when they were controlled by the foundations. The problem with the banks to begin with, and it carried over to the new regime, was a lot of cronyism in lending. The local business people who knew somebody on the board of the bank or the company would get a special loan, and other people who didn't know the people in the bank didn't get one, very personal kind of stuff. And it was very bad. And the foundation ownership didn't help things. It's still all who knows who. But it's different. They're set up differently from the foundations. It isn't a firm that starts off being very well managed under a brand name, Mr. Svensson, and who then passes it on to some other guys who also have no special self-interest and are charged with managing the firm well. There's no standard before, there's no reputation, there's no, and the people that it's passed on to in Italy were corrupt. Not too careful. And let me say in Denmark, the same thing happened.
I just can't hear that. I have to stop. Finish this.
The same thing happened in Denmark. They had the same thing. They had a bunch of state-owned banks. They privatized them the same way. They split them up into a foundation, a non-profit foundation, and a for-profit bank. The foundation held a majority of the stock in the banks, and there were big banking scandals. We don't include the financial firms in our data here, principally because of accounting reasons, but also they have a different history in Denmark. They look just like, their origins are just like the Italian banking foundations, and the performance is not quite as bad as the names, but to the extent names can be like clients, they did.
I think, in the interest of time,